Hey everyone, welcome back to Quick Read Reviews. Today we're delving into a foundational classic in the world of finance, A Random Walk Down Wall Street by Burton Malkiel. If you've ever wondered about the intricacies of investing and the stock market, this is the video for you. Let's dive in. Efficient Market Hypothesis, EMH. Starting off, Malkiel introduces us to the efficient market hypothesis. It's a fancy term, but the essence is this. Stock prices at any given moment reflect all the information available. This means trying to beat the market consistently is a tall order, as prices adjust almost instantaneously to new information. The implication? Well, if the market is indeed efficient, then stock picking in hopes of consistently outperforming becomes a game of chance, not skill. This challenges the traditional view of many investors who believe they can find undervalued stocks ready to soar. Malkiel provides compelling evidence for this hypothesis, making a strong case that for the average investor, trying to outsmart the market is a daunting, if not impossible, task. Random walk theory. The book's title itself stems from the random walk theory. Simply put, stock price movements are unpredictable and follow a random walk. This means short-term stock price movements are essentially random and don't follow a discernible pattern. Many have tried to find patterns, using intricate charts and graphs, hoping to predict the next big move. Malkiel, however, argues that these endeavors are mostly in vain. The stock market's randomness, influenced by countless variables, makes it a complex beast. He suggests that while in the short term, stock prices may seem chaotic, over the long term, they generally reflect the intrinsic value of companies. This is a crucial takeaway for those tempted by the allure of quick speculative gains. Buy and hold strategy. Given the market's unpredictable nature, what's an investor to do? Malkiel champions a buy and hold strategy. Instead of constantly buying and selling in an attempt to time the market, he recommends building a diversified portfolio and holding on to it for the long haul. In particular, he's a strong advocate for index funds. These funds, which mirror broad market indices, offer diversification, reduce risk, and come with low fees. They're a way for investors to ride the market's general upward trend without the need to pick individual winners. Malkiel's advice resonates with the idea of passive investing. By reducing unnecessary trading and associated costs, investors can often achieve better net returns over time. Critique of technical and fundamental analysis. Throughout the book, Malkiel examines popular stock-picking strategies. From chart patterns to earnings analysis, he delves deep. But his conclusion? Most of these methods are unreliable at best. Technical analysis, which involves studying price charts to predict future movements, often resembles reading tea leaves, according to Malkiel. The patterns are subjective, and what works one time might not work the next. Fundamental analysis fares slightly better in his view. This method, which involves analyzing a company's financial health, does have merit. However, Malkiel warns that even solid analysis can be thrown off by unforeseeable market factors. History of speculative bubbles. A captivating part of the book is Malkiel's exploration of speculative bubbles. From the infamous tulip mania to the dot-com bubble, he dissects the psychology and factors leading up to these financial frenzies. These historical dives serve as cautionary tales. They remind investors of the dangers of herd mentality and the consequences of straying from fundamental value. It's a lesson in humility, highlighting that no matter how advanced we think we are, we're not immune to collective irrationality. In each case, Malkiel underscores a recurring theme: the cycle of euphoria followed by a painful crash. It's a potent reminder to remain grounded, stick to fundamentals, and avoid getting swept up in the next big thing. Personal insight. Before picking up A Random Walk Down Wall Street, I'll admit my investment approach was a mix of hearsay, trendy stock picks, and a dash of hope. I'd often find myself drawn to the latest buzzword in the financial world, making impulsive decisions based on fleeting market sentiments. Malkiel's book, however, was a game changer for me, serving as both an eye-opener and a grounding force. One of the first revelations was the efficient market hypothesis. The idea that all known information was already reflected in stock prices made me rethink my strategy. I started to question the feasibility of beating the market and realized that my sporadic trading, driven by attempts to time the market, was perhaps more luck than strategy. This understanding led me to reduce my frequent trading, cutting down on transaction costs and the stress of constantly monitoring stock prices. Malkiel's endorsement of index funds struck a chord. I began transitioning my portfolio, focusing on broader market indices. The simplicity, diversification, and reduced fees of these funds resonated with my newfound understanding. I appreciated the idea of mirroring the market's growth rather than chasing elusive, high-risk returns. Lastly, the historical tales of speculative bubbles were both fascinating and cautionary. They instilled in me a sense of humility. I became more critical of the latest investment fads and more attuned to the timeless principles of value and fundamentals. In essence, a random walk down Wall Street shifted my perspective from seeking quick gains to building long-term wealth. It taught me the value of patience, the importance of financial education, and the wisdom of simplicity. Today, my investment approach is more informed, strategic, and most importantly, aligned with my long-term goals. A random walk down Wall Street offers a comprehensive look into the world of investing. It's a blend of history, theory, and practical advice, making it a must-read for anyone looking to navigate the financial markets. If this deep dive piqued your interest, give this video a thumbs up and share your thoughts in the comments. And if you haven't subscribed yet, hit that button for more insightful book summaries. Until next time, happy investing.